Ladies and gentlemen, you are welcome. Good afternoon once again. We continue to welcome you in the series of webinars we are conducting at the Institute. My name is Benedict Buhangzi. I work as the Membership and Business Development Officer at the Ghana Institute of Banking and Financial Services. Today, we are privileged to have our colleagues and our partners in this whole series of webinars. That is the NSSF team that will be facilitating this webinar. And today we are talking about just giving a recap and looking at what are some of the stories that these retirees have gone through as they use their retirement benefits. We have success stories, some in a way have failed, and we want to dig down and find out what could be those issues that help others succeed while investing their retirement benefits and others fail. In the same spirit, will come Mr. Mbowa Apollo, as well as Madam Becky Kabugo, who will be taking us through this session, and we'll be glad, and I hope that everyone will be in position to pick a word or two regarding planning for our retirement. And as we reflect on these success stories that some of the people have gone through as they invest their retirement benefits. Remember, we had a talk from Ulbra, so we're painting a picture of both the private and the public sector to see what are some of those things, what are the do's and don'ts of the retirement packages that these people receive, that we are all going to receive at one time. What are the do's and don'ts of these monies that we receive in lump sum as we try to invest them into profitable ventures that will give us a happy retirement. I will call on Mr. Apollo to take it over from there, and then we'll dive into our presentation, and we look forward for the best. Good luck. Thank you, Mr. Apollo. Good afternoon.
Thank you, Benedict. Thank you so much for hosting us here. As Benedict has told you, this week in the campaign we are highlighting retirement stories, and one of the things that we are going to do today, 3 days through the weekend, we are going to be airing a few videos of retirement stories, retirees, how they have spent their money, what have they done. Fortunately or unfortunately, we may not air one where people have failed, though we are now working on that series where we can find the failed stories. But over the next, starting Friday, we are going to be airing those stories of a few clips of about 5 minutes about how retirees have spent their money. But before we get to that, we needed you to understand the full picture of why is it that so have failure stories? What is the true picture? What is the big picture around NSSF money? What's the big picture? What does it mean for you? What does it translate for you? My name is Apollo Mbowa, as he said, and I head the financial literacy unit at NSSF. And what the financial literacy unit is basically trying to run an awareness of what can people do before they get to retire, before they get their NSSF money, that they will feed into their retirement. So that by the time you get your NSSF money, you don't start. We cannot have stories of people who have started and succeeded. You need to just continue. So my mandate is to make sure people can start something while they are in retirement. But today we want to go back and look at the bigger picture. What are those numbers behind the NSSF money, our money, or how we call it, our money? What the numbers behind our money? And I would want to hand over to Rebecca Kabugo Mugisha, who is the customer experience manager, and that's the person who is in charge of you when you come in for your registration, when you come in for your benefits, and when you are with us between picking your benefits and between registration and picking your benefits. She's the person in charge to make sure that NSSF remains relevant to you. And financial literacy is one of those points she looks at. Rebecca, us the highlights of the bigger picture behind the NSSF numbers before we start tomorrow highlighting the success stories. Thank you so much. Becky, over to you. Becky?
Thank you very much, Apollo, and thank you so much, Benedict. Can you hear me now? Thank you, Benedict, and thank you, Uganda Institute of Banking, for inviting us and partnering with us to have this money conversation. Benedict, if you'll please help me put up the PowerPoint. I welcome everybody who's logged in to this money conversation. It's very important to the key players in the market. And I particularly like the topic because it has the word story. Even as the presentation comes up. But like Apollo said, before we go into the details of highlighting and celebrating the various stories that are successful, we do have them. We would like everybody to understand the background by looking at some numbers and seeing the story behind those numbers, because behind every statistic or behind every number is actually a story. And so even before we go into the presentation, I just wanted, for those who are listening in, to know that from where we sit, we meet so many customers on a daily basis who are coming in to access their money at different points in their journey with the fund, either at midway or at the end. But as you will see with the numbers that come later, we interface with so many stories that come before us. And the sad thing about a lot of the stories we are interfacing with is that we have a bulk of us that get desperate, and that's the narrative we want to change. Get desperate before retirement. I was talking to Benedict earlier, and I was telling him that I'm not so sure about the topic in itself, success stories at retirement, and I wish I could tweak that topic to mean your story needs to be successful at retirement. And that's the reason I would like us to go through the numbers that we're going to see today. So even as we look at the numbers, I want you to focus on your own story. The successful stories that we have had in the fund will be aired in the next 3 days, but I want you to focus on your own story. And if Benedict will allow me to tweak this topic to mean your story, your own story, whoever is listening in today, your own story needs to be successful at retirement. And here is why. I'm going to tell you why. Like I've said, we have interfaced with so many people. Benedict, I'm waiting for the PowerPoint to go up. We have interfaced with so many people that come in to get their money before retirement. And we're going to look at the picture and the reason why. And we would like this narrative to change. And behind every single statistic you'll see today is actually a story. But more importantly, I would like you to see yourself in this statistic and how your own story fits into the picture we're going to paint today. And if you will allow me to tweak the topic for today to mean that your own story needs to be successful at retirement. So let's look at the numbers behind the stories. And I don't want you to narrow it down to success. It's a broad aspect. The numbers behind the stories. Okay, so as you will see on your screen, we have 42 coming to 43 million Ugandans. But out of those 43 million Ugandans, I'm sorry about that. I just needed to be in presentation mode. 43 million Ugandans, but out of those 43 million Ugandans, only a few of them have a regulated savings scheme. If you look at the numbers on your screen, you will see that out of 43 million Ugandans, 17 million of those are said to be in the working age group. What does that actually mean? It means that if you are between 16 years of age and 65 years of age, you have the ability to exchange your passions, your skills, your intellect, and everything that you know in the marketplace for a salary. But if you look deeper into that 17 million, out of 43 million Ugandans, 17 million are supposed to be in the working age group. If you look deeper and delve deeper into those numbers, of those 17 million, 6 million of those have are purely subsistence farmers. So what does that mean with a balance? Where are those balanced people? Are they working in the informal sector? Are they working in the formal sector? When we get to the pension schemes and the regulated saving schemes in the environment, we have seen that of all the 43 million Ugandans, only 2 million have a regulated saving scheme. Some of those are in NSSF, others are in other regulated saving schemes, but only 2 million Ugandans out of 43 million Ugandans have a regulated savings scheme. If you are among those guys that have an account at NSSF, count yourself lucky that out of the 43 million Ugandans, you're among the 2 million Ugandans who will be happy at retirement. And that is why we have gone out of ourselves to say that what can we do to make sure that your story is successful at retirement. Our hope and dream is that of the 17, if we boast of having a 17 million workforce or labor force, our hope and dream is that we shall see those numbers, 17 million people able to exchange their abilities, their skills for a salary. We should be able to see those numbers with a regulated savings scheme so we can celebrate. We can even have a bigger celebration. I wished when I saw this topic that I could actually tweak it to say that your story needs to be successful at retirement. And like I said, that from where we sit, we interface with so many savers who want to get their money before the point of retirement in desperation. And the numbers that I would like to show you today would paint the picture of why we interface with so many of those stories. And that is why we are saying that even as you look at these numbers, I would like each and every one of you who's listening in to see your own story in these numbers. Then over the next few days, we shall air the successful ones. Obviously, we have successful stories, but we want even more successful stories. So let's continue and look at the numbers within the fund. So when we look at the membership breakdown, you will see that we have 1.3 million members who are saving with the fund. So if you're in this room and you're listening today and you're among the savers, please count yourself lucky. Of those savers, we have active membership and dormant membership. What does that mean? That 48% of the 1.3 million on a monthly basis, that day when you get your salary paid and then you get your SMS that says, pink, your NSSF has been paid on this account, X amount, and the balance has moved from X to Y. You are only 629,000. We shall come back to that number later on when we look at the numbers in Uganda. I had mentioned them earlier before the PowerPoint got off. And the dormant, 52% of our members are dormant, meaning that at some point somebody was working and they had a regulated retirement savings scheme, which is NSSF, moved out of employment before retirement, and they can only wait on a monthly basis, on an annual basis when interest is placed on their account to increase that balance, but they're not increasing it actively through a salary. As you can also see, the male versus the gender balance, males among the savers are 67%, females are 32%. So when we get down in this room, I don't know how many females or males are in this room, or when you go to the different households, it could be your household, it could be your sister's household, your friend's household, your neighbor's household. Chances are that the men in those households are saving and the women that they stay with are not saving when you look at the numbers of savers. The story or the picture even gets more dire when we go into the specifics of how much money do they even have on their account. I know that some of you might find these balances shocking because when you look at your own NSSF balance, it's probably above 1 million. But can you believe that 33% of our active membership and 59% of our dormant membership have less than 1 million on their accounts? Again, we shall go back to what does that mean and what do we need to do and what does financial literacy mean to us? And then when we go to 1 million to 50 million, we can see that 60% of active and 40% of dormant have between 1 million to 50 million shillings. I would like you to ask yourself those questions. If you are the person in that story behind that figure, what can 1 million shillings do for you at retirement? And what can we do to make sure that we change that narrative? And I'll keep repeating this, that I wish, again, the topic for this session would be that your own story, whoever is listening today, your own story needs to be successful at retirement. And that is why we're going back to this bigger picture. And only 1% of dormant and 7% of active have above 50 million at retirement. This money can go as high as $1 billion, 500 million, 100 million, 80 billion. But the lowest percentages of people among dormant and active are the ones that have the bigger balances. Let's look at more numbers. Let's look at more numbers in the next slide. This is just a deep dive into the 48% who are the active members. Remember the entire population of the fund, and please don't get bored with the statistics. I just want you to know that behind every statistic is a story. You might look at 629,810, and that composition is you and I who are lucky to have a salary today and actually actively saving on a monthly basis. So if you look at the breakdown, you will see that. Just a moment, please. You will see that one, dormant membership is above the active membership. You will also see that on a monthly basis, when we're paying out benefits, we have about 2,200, 2,400 that are eligible to claim at retirement, and we have a payout of 48 billion on a monthly basis on average. And again, what you're asking ourselves at that point, and I would like you to see yourself in that story when you come to claim, maybe 2 years from now, 10 years from now, 5 years from now, just know that on average, we're paying out 48 billion in bulk. And the question is, what are we using that money for at retirement? We want those stories to be successful because we're not seeing enough success stories at retirement. And I'll share with you the reason later why. How do we make sure that that 48 billion translates into stories and income streams of people that will be happy even beyond their own generation, where this retirement money will speak not just to their lives 2 years after leaving the workspace at 50 or at 55, but even the lives of their children. We also see that the average saving period for our members is 6 years. As you all know, we have different claim types, but on average, when people come in to get their money, they're saving for an average of 6 years. But then you also know in your own story that you started working probably at 20 years old, 25 years old, and you're likely to retire at 50 years old, or even 60. Is it possible for that number to go up? Is it possible for us to save for more than 10 years? Is it possible for us to save for more than 15 years, for more than 20 years? We've heard of nations and countries. We know that the Jews and the Indians, for example, have an amazing savings culture. And you will find that children start to save and learn how to save when they're still, even before they join university, as long as they still, as long as they get into a habit of making some money, even at home, their saving culture starts way before they hold their first paycheck. But we are seeing that for us in the formal sector, our average years of saving are only 6 years. So little wonder those balances that I shared up there, I hope that they've shocked some of you, and I hope that some of you will be inspired to change this story, not just for yourself, but everybody in your circles of influence. Is just 6 years average saving for all our members. But you'll also see that 80% of the bulk of that 13 trillion that you hear about in the fund is owned only by 20% of the membership. Again, I will go back and reiterate and repeat myself that what the topic for today needs to be is that your own story, the 49 of you that are listening in, and the people who are at the panel, that your own story needs to be successful at retirement. We need to change this narrative. And I know that some of you are already thinking, why is it like this? So we're going to look at even some more numbers. So when I had just started, I told you that we are 43 million Ugandans. Indeed, we are. It's just very sad when you look at those numbers, the 43 million Ugandans, we look at those numbers and you see that of the 43 million, only 2 million have a regulated savings scheme. But among the 43 million, 17 million can actually exchange their abilities, their passions, their intellect, their qualifications for a salary. Benedict, please go to the slide that has the, okay. So of the 2 million that have a regulated savings scheme, only 1.3 million are in NSSF, and you've seen the breakdown of dormant, you've seen the breakdown of active membership. And I know that every single time you look at this 13 trillion financial institution, everybody's proud when you look at that number in bulk. But if you were to divide the 13 trillion with the 1.3 million members, guess what? All of us, flat rate, would be walking away with just 1 million shillings. But remember, we are talking about retirement. We are talking about somebody who has been in the workspace from when they were 20 years old or 25 years of age up to when they're 50. And that number should look a lot better than 1 million. We're talking about what can 1 million do at retirement? What else can we do to change this narrative? What else can we do to change our story? So we have done research, and like I said, the reason why we started out with a financial literacy agenda is because a lot of people were coming to us at the point when they were not qualifying to get their benefits. And so we started to ask ourselves the question, why? I myself, I have worked in different places. I have been working for more than 15 years. And when I came and joined the fund as an employee, I haven't always worked in the fund. When I joined the fund as an employee, and I understood that saving is a big part of my financial wellness, or saving is a big part of my success story in terms of retirement, in terms of my family, I asked myself the question that if NSSF is able to have, say, for example, 40 million, I'm just giving an example of my balance, how much money has gone onto my account ever since I started working? I started to ask myself questions like that, because when our savers would come to us when they're desperate to get their money before retirement, we needed to do a dipstick and find out, is it that we don't have access to money? Is it that money actually comes our way and we don't know what to do with that money? My own story was that over the years, money had come to my account, but I didn't exactly use the cycle of wealth, or I didn't use informed financial methodologies and patterns to make sure that my money can increase from point X to point Y. And perhaps I will be among the people that have a success story at retirement. So when we did a research and we went and looked at FinScope and some of the numbers out there, we discovered that, guess what? 56% of Ugandans get financial information or financial advisory from a household member. What does that mean? That at any one point in your time, if you ever held money in bulk, I'll even take it to before you retire. For instance, if you've ever gotten a salary loan is that point in your time when you get money in bulk. Or for those of you who work in companies where you get bonuses, at that point when you get that money, research shows that that money doesn't even have a shelf life of 1 year, doesn't have a shelf life of 2 years. And yet before you got that money, you had very, very good intentions of what you wanted to do with it. And you were so sure that that money would outlive a certain shelf life. So when somebody gets money in bulk, they go and ask their father, they'll ask their mother, they'll ask a friend. I have 200 million here, I've retired. I have 20 million, I've gotten a bonus. I have 30 million, I've gotten a salary loan. What do I do with this money? And you know what would happen? The advice that that person gives you, they don't have any evidence that they have been successful as a story of their own. So your mother or father will tell you, my son, my child, you need to go and buy land in Wakiso. Ugandans love buying land. You need to go and buy land in Chanamkaka. But your father doesn't have a success story to say that you need to buy land in Chanamkaka because 2 years ago I bought land. 1 year after that, this is what I did with the land. 3 years after that, I was able to increase my yield on this land either through agriculture, or I flipped that land in 5 years and it brought me 5 times the amount. And I've done that 20 times. And if you look at my account, all this, the entire storyline of my success story with financial wellness comes from land. And then you will make an informed decision and go and buy that land because your father has told you their success story, which is evidence-based, which is data-based. And then you'll go and buy land because you have it's coming from an informed perspective. Or somebody will tell you these days everything is about piggery. But whoever is telling you doesn't have a success story in piggery. So guess what? You get your 20 million, 30 million, 40 million, whether it's through a salary loan, whether it's through a bonus, or at that point in retirement, because those patterns speak to us even up to retirement. What you did with that salary loan, if you have nothing to show for it, chances are if you don't go through a financial wellness course right now, you will have the same exact pattern at retirement. And that is what we are seeing with these numbers. So a person will tell you piggery is where success stories are, or is where money is. And people have made money with piggery, but whoever you're getting financial advice from does not have an evidence-based storyline to show you how they were able to multiply money from X to Y in the area of piggery. And that is why the stories, I'll refer back to Benedict, that's why the stories are not successful as we would like them to be. That is why we don't have enough success stories as they ought to be. And that is why we are seeing that when you're looking at these numbers, I want you to see your story in this number. I don't want you to wait for somebody else's story. We shall air the successful stories, but I want you to see yourself in that number. If you have ever gotten money in bulk, because right now at retirement, we get money in bulk. If you have ever gotten a salary loan, bonus at some point, and you had nothing to show for it after 2 years, chances are the same thing will happen at retirement. But because we're having these money conversations, it will not happen. And that is why we said that this topic needs to be that your story, your own story, needs to be successful at retirement. Let's move on to another figure that makes my heart pain and makes me think about financial literacy aggressively and makes me talk about financial literacy everywhere I go, to my family members, to my friend. And that is the one that is actually speaking to retirement, that only 5% of retirees, previous slide please, that only 5% of the people that retire experience financial independence. I would like us to place this in the context of a story. Let's just imagine you're in this room. You have been hustling and working for 15 years, 20 years, 30 years. You all know the workplace is a hustle. Some of you wouldn't want to wake up in the morning at 8 o'clock and walk away at your desk after 5 p.m. Some of you would want to, some of you may not want to. It's a daily grind, but the reason you do that because you have goals, you have objectives to achieve. So imagine you've been hustling away for 10 years, 15 years, 20 years, and bang, 50 years clock, 55 years clock, you retire, and then somebody tells you they've done a research and only 5% of the people that retire enjoy financial independence. What does this figure actually mean? Like I said earlier, behind every statistic is a story. Behind every figure is a life, is a family, is a husband, is a child who's going to school under somebody's roof, is an extended family of so-and-so in the village who gets money from you on a periodic basis to go for medical or to do school fees. But now the research is showing us that if we are 100 people in this room, only 5 at retirement, for instance, if they were driving a Mercedes-Benz, they will continue in a Mercedes-Benz. If they were driving a Vitz, they will continue in a Vitz. If they were having 2 meals a day, they will continue having 2 meals a day and the life that they were enjoying before they started retiring. These 5% probably have a good dose of financial literacy information. These 5% have probably been saving even way before NSSF came into place. So when they look at the NSSF balance, it's just a part of their so many savings that they have. The other 95%, and I'm hoping that you will not be among those numbers because we're having this money conversation. The other 95%, I have been having a Vitz at retirement. Guess what? I downgrade to a taxi. If I've been moving in a taxi, guess what? I start walking. If I have been walking to work, guess what? I start depending on my family members to get by. And that is why we are crying out that these numbers do not make sense. And we need together to change this narrative. And when we talk about the topic success stories at retirement, I want you to look at yourself as that story in these numbers and make sure that you're among the 95% and not among the 5%, and make sure that you're among the 44% that will have an informed dose of financial information before you make a financial decision to spend even one shilling of your money. Why? Because you want to see it move from point X to point Y. Another number which is not here that I'd like to talk about before we go into the next slide is a 95 versus a 5%. And for me, it speaks a lot as an employee. Like I said earlier, when I came into this place to work, I wondered why I hadn't saved a lot more from the time when I started working, because NSSF takes 5% of my base salary. So I sat down and calculated that other money that has gone through my account. We call it 95%. 95% is just a metaphor. It's probably 67 or 65% after taxes, after your taxes and NSSF. But that money that goes to your account after NSSF has taken off, just that 5%. I sat down and did the maths in an Excel sheet. I got my statement from NSSF from the time that I started working. I just want you to know that my jaw dropped. And when I looked at my life, I didn't have anything to show for that I'll call it 95% as a metaphor, that 95% that had gone through my account. So when I looked at the 5%, what NSSF has done with my 5% from my best salary, I'm not even talking about the employer, what the employer has given for me. When I looked at what NSSF has done for myself, I wanted to take this message to schools. I wanted to teach my children about this message. Why? Because I wanted to have challenged myself to be at a point where the assets that I have to show for the money that has been through my account, because I have been privileged enough to be salaried, should be able to challenge the balance that I see on my NSSF statement. Every single time I talk to people about financial literacy in different companies, I ask them to look at their NSSF balance and they always smile. Then I ask them to look at their asset base and their own accounts and the smile goes down. But that should not be our story. The reason this is our story is because we're not having enough money conversations, and we need to have these money conversations long before retirement, so that by the time you retire, this figure that is saying only 5% have financial independence after retirement is way up the roof. We need this number to go to 50%, to 60%. Even the other figure that we saw, that only 2 million have regulated savings schemes in a population of 43 million, where 17 million can exchange their strength, their abilities, their qualifications for a salary or for some form of employment. The numbers for a regulated savings scheme need to be up the roof and challenge our dashboards. Now we're going to look at other numbers again, and I hope I'm not making anybody sad here as I listen to all these stories and compare what I'm talking about to what the topic is, success stories at retirement. Like I said earlier, the success stories are there, but we need to have more success stories. But even more importantly, as you look at these statistics, they're not just numbers. I need each and every one of you to see yourself in these statistics. If you don't see yourself, at least see your children in these statistics, or see your household, your extended family, your aunties, your sisters, or even the generation that will live long after you. So when we look at those broad categories, we said, you know what, let's take it even a step deeper or a notch higher and talk to people that have actually retired. What are they using their money for? Are we getting too excited when we look at these balances and just can't wait for them so we can spend? One of my financial literacy teachers has a theory that they call it the, you know, that sound when you put hot water in an empty pan that's been on your stove for about 5 minutes. Cha! I don't know if you guys ever heard of that sound, but they call it the cha effect. That every single time a lot of money goes onto our account, it goes through a cha effect and it evaporates somewhere because we're too excited to handle that huge balance and we end up losing it. Another person, still in my financial literacy classes, one of my teachers said that if my money temperature, and it's just an example, but these are realities, and for me they speak to my own life, and even as I speak about these numbers, I want you to reflect to your own life before we start sharing the success stories. So this person told us another theory still, that each and every one of us has a money temperature. If my money temperature is, say, 500,000, the day that I get 20 million Uganda shillings, that cha effect will happen, and I will look for every single place to spend that money until I have a perfect balance of 500,000 shillings. Why? Because that's my temperature for money, because I haven't developed a discipline of financial habits throughout my life over time to make sure that I have a goal X at retirement and I have building blocks to that goal X. And whether I'm seeing 20 million on my account or 500,000 on my account, it will subscribe to my goals for financial wellness at retirement. But if somebody has a money temperature of $1 billion, I know that recently we had a guest speaker from South Africa when we were graduating different people in our financial literacy classes, called Vusi, and his money temperature is $1 billion. $1 billion. I have my own, but I won't share it because I'm not seeing your faces. If I was seeing your faces, I would share it. So if Vusi with his $1 billion is his money temperature, that means that whether he gets $1 or $3,000 or $40,000 is not yet there. Guess what? Because his goal is $1 billion, he will make sure he does whatever it takes to build that $1, $3,000, $40,000 to $1 billion because his temperature for money and wellness is at that goal. So when we went and interviewed our people, even when they retire, because the numbers were not looking fine, one of the other big numbers they didn't share with you is that 80% of our people lose that money within 2 years of getting it. And that is why I'm doing a lot of parallels and reflecting back to that point in your time when you got a bulk amount of money at once, because retirement is like that. That time when you got a salary loan, or when you got a bonus, or when you sold your father's land and got an amount of money that you're not usually used to. What do you do with that money? So after finding out that 80% of our people, the shelf life of their claim is just 2 years and nothing more, which is very sad, because you know that our mortality rate as Ugandans is not 2 years after retirement, it's long after that. People are living more, people are living healthier. So imagine you retire at 50 and you're going to die at 80 or 90, but then the money you have been saving while you're hustling in a workspace leaves only for 2 years. What happens next? You're going to go to your dependents. So let's look at the reasons that people are spending this money on when they retire. The first three reasons, for me, they actually break my heart, because the first reason is to build a house and improve your home, and I'll talk about them briefly. Again, I want to see yourself as a story in these numbers. The second reason is to start a business. The third reason, let me just talk about the top three, is to acquire land. So if I get my payout at retirement and I'm building my home or improving my lawn, and I wish I could see your hands right now, will that bring food on my table? It will definitely not. And 45% of our claimants are spending their money by building their home at that age, not even to build rentals to get an income, but building or improving the home that they're going to stay in. The next 15% of people are spending their money by starting a business. If you start a business at 50 again or at 55 again, chances are that business will not succeed, because you haven't gone through the grind of learning and failing and understanding and building it from scratch. You're just building it at 50 or 55. Chances are you don't even have enough energy. You don't even have enough energy to pour into it, or you haven't built the business acumen to make sure that you can see, for you to pour all your retirement benefits into something you're just starting to understand at that age. And that is why the shelf life is also not as long as it would be. The third reason people are spending this money on is to acquire land. Now, we all know, I know that Ugandans love buying land. We also know that for you to gain out of land, you need to give it time. So if I'm buying my land at 50, if I'm buying my land at 55, I will be frustrated. My money will probably run out. And before long, I want to flip it before it gets the value that I anticipated, because I haven't given it the element of time, and then I will lose out. So again, these numbers are showing us that we have not developed the financial habits that are needed over time while we are still working, to make sure that we have our success stories as individuals at the point when we are 55, at the point when we are 50, at the point when we are 60. And it goes back to the numbers that I showed you earlier. Even as a nation, our savings culture is not where we'd like it to be. I know that our neighbors in Nairobi have a very good savings culture compared to us. You will find taxi men in a circle. They even write, they paint all their matatus with circles. You will find women with their stalls in a market, which is like our window here, in a savings scheme over time. And Kenyans are the people you hear about in the corporate setting who will say, you know what, I'm saving up for vacation, I'm saving up for my child to go to university, I'm saving up. So it's not just about the informal sector or the formal sector. And we need to bring that same vibe to our country, because when you look at the numbers, you will ask yourself, there's a question we usually ask ourselves. There cannot be a big enough or a small enough excuse for somebody not to be able to save, because that's the beginning of financial wellness. If I'm able to save, then I'm able to have something that I can use to multiply that money in form of an investment. And I need to do that at the onset, or even long before. That mindset needs to be cultivated even before I hold my first paycheck. Our mandate as a fund is to make sure we take that conversation, even if people hold their first paycheck in the marketplace. Why? Because if I understand these things at 55 or at 50, chances are the statistic, I'll be part of that bad statistic. And where we're having these money conversations today is because we want to change that narrative and make sure that each and every one of us listening in this room, our stories will be successful at retirement. As you can see the entire list, I will not say that, as you can see, as the entire list goes down, there's point number 4, we spend our money on self-education or on dependence. We know we live in an extended family setting. We're a very communal people as Africans, as Ugandans. But who said that I can't have a different plan to help my dependents even while I'm working? Do I have to wait for my retirement money to feed into dependence? If I'm giving my money to my dependents, will that put food on the table 2 years from now, 3 years from now, 4 years from now? Can we think outside the box and find different ways of helping ourselves and our families in a way that brings back money for all of us, and not just waiting for that package to make sure that I pay for somebody's school fees? There are so many questions to ask. and so many conversations to have, but I just want us to challenge our thinking and challenge our narrative and challenge our story. Let's go to what the fund is doing because of what the numbers are telling us, because of the sneak peek that the statistics are giving us, what's happening around us. The success or failure of any retiree is rooted in their timing when they take action. I've kept repeating and repeating and repeating. And when I joined the fund as an employee, one of the things that I told myself is that I wish somebody had told me all these things when I was still before I hit the marketplace or when I got my first job. Or I'm very, very sure right now, I would have done a lot. I would have taken so many different decisions concerning finances. And it's not like I'm very entrepreneurial at heart, but I've made so many mistakes along the way. Why? Because of the information that I'm learning today, I didn't know it earlier. Luckily, I'm not yet at retirement, and I'm challenging myself to make sure that my story at retirement outlives me and even goes to the generation after me. So let's go and see what the fund is doing in this space to make sure that our stories are successful at retirement, that your stories are successful at retirement. Benedict, next slide, please. Okay. So our focus is to look at our people long before they join the marketplace. On a personal level, I've taken this conversation, I don't even know what to use, but I've taken it very, very, very personally. I went to a place where I started to teach my own children about financial literacy. I don't want them to first wait to get into uni. They actually have to work for a penny. There are things that I give them to do on a weekly basis, and I give them money. You guys are bankers or friends to bankers, so I'm sure you know these things already, and I'm sure your children will be different when they start to work. But and there are so many things out there, but I've told my children a thing or two about saving. I've told them about the 5 jars, if you guys have heard about the 5 jars. So they'll work for me on a weekly basis, and I'll give them 1,000 shillings for a particular chore that I will not mention here. And when they get that 1,000 shillings, I've taught them to make sure they divide it into 5 pots. So one of the pot is 50%. So on every 1,000, they'll get 500 shillings and put it aside, and I'll tell them that money is for you to eat. They'll also get 200 shillings, and I'll tell them that money is for you to multiply. So they name that Team Grow. They'll also get 100 shillings, and I'll tell them that money is for you to tithe. So when we go for prayers, make sure you pick from that box for you to give to God. Then they have another 100 shillings that I tell them that money is for you to give in case you have a birthday for your friend and you have to buy a present. You come to that team that has giving and you choose what is there. If there's nothing there, you can't give anything at that time, because if there's something there, then you can give. And then the last box of 100 shillings, I tell them that one is for emergency. So what I've done just to help them get the psyche of money long before they hit the marketplace. If somebody hurts themselves and blood comes, guess what? We shall go to that tin of emergency, get money. If it's not enough, I'll add for them, and we shall go to the shop next home and buy a plaster. So they will know when they have a problem. They pick from that box. When they want to spend and buy toys, I tell them I don't have money. How much money do you have in your box? And they will go in the one that has 50%. And they know that this one is for eating. So if I want to buy toys, I will come to this. Why? Because I want their psyche of money to be organized before they hold their first paycheck. Because I asked myself, can you imagine if I was saving just 20% outside NSSF? Imagine if I was saving 20% when I started working. If I asked you guys here, the first salary that you got compared to the salary you're getting right now, and chances are at that time when you got the first salary, you're probably not married, you probably didn't have children, you could even have saved 30% of your salary outside NSSF. Can you imagine if you had done that consistently? If we had time, we could go through the compounding effect. You would be surprised, but let me just summarize that. Imagine if you got an Excel sheet and you were getting 200,000 shillings on a monthly basis. If you saved 40,000 of that 200,000 shillings for 30 years and subjected those savings to even some form of passive income, went to a bank, negotiated a rate for an FD account, believe me or believe you or believe me or not, if you were still getting that same salary 30 years down the road, guess what? After 30 years at the magic of compounding, you will be able to get a monthly payout of 2 million. But remember, you're at your desk slaving and you're getting 200,000. But nobody ever taught us these things before we hit the marketplace. When you learn these things now, you're wishing, I wish somebody had told me these things before. And that is why in pre, the fund is going to schools and universities to spread this message. But like I said, for me, the message is personal. I'm even going to my children and my friends' children, and we're spreading this message. Why? Because they need to enter the marketplace with the right psyche about money. We have seen countries and nations that have taken this thing to another level. I once had an Indian boss who quit his work because he didn't like his boss, and he took his family to the UK, and his wife was this guy was not even, he was about 50. He took his wife to the UK, his family to the UK. His wife was a stay-home wife, and he had to take his children to very, very good schools. He was called Shail. And I said, Shail, how are you? You're taking your whole family to the UK to study for 1 year, as in to take a break away from work. Like, how are you going to do that? He told me one thing. He said, Becky, I am an Indian. And you know what he meant? Of course, I went to ask him so many questions. So the first thing we learn from a family level is to save, 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 and understand the value of money. You don't spend unless you see the value that is coming out of where you're taking that money. And so that psychology goes with them when they enter the marketplace. And that is why they can brag about fourth generational wealth. And that is why when we go into the internet and ask who are the richest people in the world, we hear about Jews. They don't reach, they don't stagger into that kind of stereotype of Jews are rich, Jews have money. No, guess what? They have habits that they start all the way from home before their children hit the marketplace. You find Jews at university lending money, children lending money because they know that I have a jar for 20%. I've been saving this jar and it's for growing. And I can use this money to lend and people will give me a return, and I'm not supposed to touch that money. So anyway, just to summarize the pre, one time my son asked me, but mommy, that jar of 20%, does that mean I will not touch it until I'm Jaja Mkade? And I said, that's exactly the point. You're supposed to put money in that jar and multiply it to make sure that that money makes you happy at retirement. So imagine in your own story, if you had done that 20% of your base salary without even thinking about NSSF, I want you to get an Excel sheet and get angry. You will be surprised how much that money would be. But because we didn't have people to tell us all these things before time, guess what? We are making mistakes at 50. We are making mistakes at 55. The numbers are actually showing for it, and nobody's blasting these numbers on a national basis to show people that, you know what, we need to wake up. Even if it means saving 1,000 shillings per day, you will not be the same person as the same person who holds 100,000 shillings every day and doesn't even save a penny. A friend of mine once told me how their dad taught them to save. So he put a 5-liter jerry can below one of their water taps, and just a drop was going in. And he said, just leave it there and come back after 24 hours. Guess what? The 5-liter jerry can was full. And that's exactly what saving is like. But again, our psyche is not shaped to look at money in terms of what is my goal at retirement? How much can I put away? How will it grow if I subject it to this investment vehicle? Which asset class would I like to drive my money? Do I have a high risk appetite? Do I have a low risk appetite? Etc, etc, etc. We are not having these conversations enough in the marketplace, before the marketplace, so we can challenge our own story at retirement. So again, just going back to what the focus is at the fund. We're going to schools to make noise about this. We have a CSR project where we are giving out tablets to government-aided schools, and on top of the national curriculum, we are putting financial literacy classes and assessments, again, just to make sure that our people have the right psyche before they hit the marketplace, that even if they find themselves in the informal sector, you can still have a success story when you are Jaja Mkade. The other thing we're doing that during the workplace, or like right now, we're having money conversations. We're having so many different cohorts, age cohorts, and different trainings and webinars. I'm sure you've seen some of them out there, but we're taking people to class, and we're saying at least sit in a class once a month for 6 months, so that again, you can have the right psyche. When the shilling comes your way, how do you spend it? How do you grow it? How do you keep it? But more importantly, how do you sustain it? The other thing we're doing that post-retirement, our focus, we are saying we must change the narrative. We must sing a song that says your story needs to be successful at retirement. We don't have enough success stories. You've seen the numbers, and we're doing different things with different age groups. The conversations we're having with people that are in our classes from 45 years old to 50 are different. We take them through a risk return curve. There are things you don't do at 50 with your money. There are things you can play with at 20 with your money, because when you lose it, you can make it again. You still have the right energy. And so we're looking at the entire life cycle of somebody before the marketplace, in the marketplace, and beyond the marketplace. Next slide, please, Benedict. And why are we doing all these things? Why? You've seen the numbers for yourself. We need to reverse them, but it's not enough for the fund to reverse them. We need to get passionate. We need to get angry, as you and me need to get angry about what's happening, so these numbers can be changed as individuals, as families, as communities. Eventually, our hope is that as a nation, we need to build a financially aware membership. There's so many things that we don't know about. There's so many things we take for granted. And again, I'll go back to that place. Don't forget, you're hustling away on a daily basis in the marketplace. So what better way to make sure that at 55 and 50, you are excited about retiring? Why? Because you had the right mindset when you were looking at your money. And it's never about how much money you're getting. It's about what habits, what disciplines you have as an individual to subject that money that's coming into your pockets to. We also need to give members options. So in the classes, we talk about different options. And there's so many investment vehicles. I gave some examples up there on what people do when they get their money. Ugandans, we love land. Everyone who's working at least has a plot of land somewhere, or has a land title somewhere in their dockets. Ugandans, we love farming. But you will be surprised to discover that there's so many investment vehicles. There's so many options that are low risk and low return, depending on your risk appetite, options that are high risk and high return, options that are in between. But again, because we're not having enough money conversations, people don't know what investment vehicle to put. My 10,000 shillings. Even if you have 10,000 shillings today, you can invest it. If you have 100,000 shillings, you can invest it. If your goal is different, you can say, you know what, let me save my money for this period of time because of this goal. And you make an informed financial decision because of what you have known from professionals, from evidence-based stories. Why? Because, again, I'll keep repeating, your story needs to be successful at retirement. I'll give you 2 stories before I end. Benedict, next. That is just a snapshot of everything that I've talked about, the things that we're doing and engaging our membership. We have workplace cohorts. Some of it is not displaying, but we have workplace cohorts. We can go into a workplace and have a tailored program specifically for the workplace. We have routine classes where we call people according to age groups, and we take them to class for 6 months, just 1 day per month, and we graduate them at the end of that period. We have engagements with university students, with secondary school students, and a lot more. I know that my time has gone, so I want to share with you just 2 stories that inspire me to think about money differently. One of them is a story of somebody who came into the workspace, who came to us because they wanted their money. They were 49 years old. They hadn't been working for about 5 years, I think. She's a lady. She knows how many times I tell her story. She should be charging me for it. But for me, it inspired me. She came to us and she wanted her money at 49 years old. She hadn't been working for 5 years. She was definitely not qualifying, but she would have qualified at 50 because she wasn't working, because you have the withdrawal benefit where you can take out your money at 50 if you're not working. She was desperate. She was a mother of 3 children. She had lost her husband, and she was telling me, Madam, I've hit the wall. I can't think, I cannot breathe. There's nothing else that I can do. My children need to go to school. I'll call her Becky for the sake of this presentation. So I told her, Becky, do you know how much money you have? She said, yes, the last time I saw my money, it was about 35 million. I was like, do you know how much it is now? I said, no, I don't know what it is, but there's nothing else I can do. I need to go back to the village. My husband died, etc., etc. So I told her, you know what? Of course, I took her through a financial literacy talk like we have done now. And then I told her, you know what? I want to show you your statement. And I also want to show you what NSSF has done with your money since you last saw it. So I printed a statement. I brought it out for her. Her money had moved from the last time she saw it at 35 million. Remember, she hadn't been working, to 42 million. I told you about dormant members and active members. This lady literally dropped her jaw. Then I told her, Becky, like I'm calling her Becky for this reason. I told her, Becky, can you promise me that if you got your money today at 49, can you promise me that 2 years down the road, I will come to you and you'll tell me, guess what, madam, my money has moved from 42 million to 58 million. Why? Because I've subjected it to some financial asset classes, so some investment vehicles, and it has moved from X to Y. The same way NSSF has moved it from, NSSF is just an investment vehicle, one of the many. NSSF has moved it from 35 million to 42 million while you were doing nothing. That's just one of the examples of a form of a passive investment scheme or a passive asset class. She said, madam, I don't think I'll be able to move that money like that the way you have moved it. And I'm shocked that I haven't been working and my money has moved from 35 million to 42 million. She said, you know what? Let me say this in Luganda. She said, madam, kangende mbere omukozi ndabirira abaana kubanga ondaze that I still have enough energy to actually make money. Because the wealth cycle is not just about saving. It's about making the money, keeping the money, and growing the money, and then sustaining the money. He said, I still have energy. I can still exchange my energy for some form of employment or salary. Because if I took this money now, I will not lie to you. I was going to bury this money in school fees, but if I bury this money in school fees 2 years down the road, how will I pay school fees? He said, you know what? I still have the energy to go out there and make money. I will come back at retirement at 55 years old. I'll only come back for more classes, but I can't tell you that I have the confidence to grow this money the way you guys have grown it in that particular investment vehicle. She challenged me, because many times we look at, most of you guys are probably listening and you're salaried. We are very privileged to have salaries. On a monthly basis, you get that SMS that your money has been paid. And then NSSF gets a text that your employer has even paid for you NSSF, but there's so many people out there who are not in the formal sector. Some are hustling away in the informal sector. Some are even more successful and money clever than us, but some are not fortunate. But guess what? Some of them, in their minds, they've blocked out the fact that they still have the, like I said, 16 to 65 years of age in the labor force. When President stands up and says, when Museveni says, the labor force is this, you can exchange your abilities, your passions, your qualifications, your skills, your knowledge for some form of payment. And that is where, before you even save, you need to understand, how do I even get the money? What income stream do I have? Is one income stream enough? Do I need 5 income streams? Do I need 4 income streams? For that lady, she got a eureka moment at that point and said, you know what, I still have the energy to go and make money and pay school fees for my children, as I learn how to multiply that money eventually when I come for it, so that it outlives my generation. The second story I'm going to tell you is about myself. It's about legacy, and it's one of the things that still drives me about financial literacy. Because it's not a financial literacy class, we're just looking at the statistics and what the picture is like, and to challenge our own stories, so that the point we get at retirement, we have a good story to tell, we have a good story to leave to our children, our children's children. So my story is about legacy, because many times when we look at money, or when we look at investment, or when we look at getting money and keeping it, we think in the short term, and perhaps that explains the reason why many of us lose that money, because we don't have the patience to test those financial disciplines over a period of time and see them working and see them building up to something. So, and I know that this is true for so many Ugandans. My grandfather was a rich man. He was called Mosei Chiwana. He hadn't gone to school, but he was very shrewd, very entrepreneurial, and is one of the people that had a coffee factory in the village. My village is in Buyukwe Chagwe. He had a factory for coffee in that. So those times they had so much money, and a lot of his children didn't even bother to go to school, because they had, worked out a model that was making them rich. But guess what? His money did not move to the next generation and the next generation. And the money conversation challenges me, because when I look at those Indians and those Jews, how is it that they're able to have 4th generational wealth? Who told them about these money conversations? So 2 years before he died, he decided, you know what, of course the coffee factory had long gone. He had so many children. He was no longer as wealthy as he used to be. But he said something that for me was such a common thing in so many African countries and so many people that I knew. who say that Jaja wange yari mugagga, but then I have nothing to show for my Jaja's bugagga, you know? Or when I come into the marketplace, I start from scratch because my Jaja's bugagga did not give me a stepping stone. So 2 years before he died, he had a plot of land in Chisenyi. He told his children, he called them and told them, guys, you know what? I'm going to sell my land and eat my money and enjoy it because I don't want you guys to kill yourselves when I die. So he sold his plot of land for 300 million Uganda shillings. He got a new wife, renovated his home, bought exotic pigs from I don't know where as a business, got himself a pickup, and he literally lived out that statement. He literally ate that money away until the last bit, until he died. The sad thing about that story is that we don't see his wealth moving from his generation to my father's generation to us, the Bazukulu, and then to the next. And it's a common thing for so many of us. You've had somebody say, or you've said yourself, the Jaja wange yari mugagga, but you have nothing to show for your Jaja's bugagga. We need to change that narrative. We need to change the story for our children and our children's children. So you know what I decided? I said, you know what, financial literacy is actually not hard, but it takes time and effort to get those building blocks to a point of financial wellness that you want them for yourself and for your family. So I told myself, and everyone in my class, in our financial literacy classes knows this, I said, you know what, our children and our great-grandchildren, we need to think about wealth and financial literacy in terms of legacy. Whatever it is that you want to do, whatever investment vehicle you decide to pounce on or to settle on that speaks to your risk appetite or speaks to your personality and your gifts and talents that you got from God, we need to look at them in terms of 100 years. Your vision is to be in terms of 100 years, in terms of 200 years. The moment you think 100 years and 200 years, your psyche automatically changes. You've heard of people like the Mercedes, the Fords, they give birth to children. Their children are now in, I don't know, 3rd and 4th generation. They don't even pray as much as we do imagine, but they don't suffer financially like we do. Why? Because their judge thought about money differently. And they left assets that their children's children are still feeding on. Why can't that be the same narrative for Ugandans? Why can't that be the same narrative for me and for you? So I decided that I want my children and my children's children to wake up one day and say, Nalinayo Jaja Becky. Because of Jaja Becky, we look at money differently. We can save even if it's a shilling, and money grows. The interesting thing about saving is that it's like an algorithm. It's like an equation. It's simple as 1 + 1 = 2. It's an equation. Put away 1,000 shillings every day and tell me if it will not grow after 10 years. And then after it grows, you subject it to the next part of the wealth cycle. After you save it, it grows, and then you invest it. Of course, you have to invest wisely, and that is why we want to encourage money conversations. And then why can't it sustain you from beyond retirement to your children and your children's children? So for me, these conversations and these statistics, even as I thought about today's topic, is just to challenge our story, to challenge your story, challenge my story, that we need to have more success stories at retirement. It takes effort, it takes time, it takes learning, but we're here to enjoy those conversations with you. So that's what I had to share with you today. Those are my 2 stories for the day. I know that Apollo has so many other stories lined up from the fund that have been successful for the people at the retirement. Again, I will repeat, they're not enough. We need a lot more success stories. And I would like you to see yourself in the stats that I've talked about so that your own story can be successful at retirement. Thank you very much. And I hope that we have learned something together today. Thank you. Benedict and Apollo, back to you.
Wow. Thank you so much, Becky. This has been so insightful. Personally, I must say, I can really feel it at heart, and we'll request really you have to share that presentation so that some of us we can familiarize with it again. And I'm sure some of us look forward to keep engaging you on such matters so that we can perfectly have the right touch regarding financial literacy. The 5% is really scaring, and how I wish each and every person could really take it as a serious figure. the efforts to turn that 95 to at least something like you said, 60 is something that we really need to work around. We need to fight hard. It's a real struggle. They're using the word struggle these days, but this is a real struggle. So I must say that the retirement is something that comes with a lot of, I have to say, worries. Mainly, I think because we've been used to getting these monthly payments that don't exceed average 5 million. So when this 200 million comes in, 300 or even 500 million comes in a lump sum, when you cha appetite, what did you call it?
You risk appetite. Oh, the cha effect.
The cha effect is going to evaporate. So really, it's something that we need to keep on. Over to you, Apollo. Kindly bridge us into another session of Q&A so that we can pose some questions to Becky. Have this conversation relevant to the listeners. I'm seeing some questions in the chat room and the Q&A room. Kindly raise them to Becky so that we can put more relevance to this whole conversation, and we say bye-bye to the listeners. Thank you, Apollo. Apollo,
thank you, Benedict. I'm going through the chat. Yes, Benedict, I'm here.
I think somebody asked, I can see a question here.
Hello, Benedict.
Becky, can you please share what would be appropriate ventures that one can invest in for productive returns on one's hard-earned savings? I request to take this question with Apollo, but what I can say to Fred Tukahira, I would like to say that please come to class. I don't want to think that deciding on an investment vehicle or an asset class should be just a one-time conversation. But what I can say is that when you come to class, you'll be able to go through what we call the risk return curve. The risk, just think about an X and Y axis that has risk on one end and return on one end. And there's so many investment vehicles in between. So you can assess what's the right one for you. Also, depending on your age, there are things that are too risky for us to get into at a higher age, and the things that we can have a risk appetite for at a younger age. But there are so many investment vehicles. There are so many investment vehicles. There are fixed incomes, which are very low return, but also low risk. You're sure you'll get your money back when you buy bills and bonds, or you fix your money with on a fixed deposit account with a bank, or get into a collective investment scheme with a firm. There's so many service providers out there, insurance companies. But then there's real estate. There's businesses. There's stocks. You can buy shares in a company. But it would be best to go through that in a methodical manner, so that you can ask yourself, where do you lie on that curve, and what's appropriate for you at whichever point in time. What can you employ to get you the yield that's appropriate? Yes. I don't know if Apollo would like to add anything to that.
Meanwhile, as Apollo comes in, thank you so much, Becky. Someone here called Richard Akuze is saying, when and where are those financial literacy classes held?
Okay, so before we have two programs. The first program is a workplace replication. Workplace replication means that a company calls us. We've had companies in the past like Toyota Uganda called us, M-Kopa called us. Right now, we have a cohort running with a UNOC. A company calls us and we tailor a program for their people. So they set the time, they set the period, and we go through an entire program, but they go through it as staff. Those are workplace replications. The second one, we have mainstream classes, and Apollo will give more insight on that. And these are age cohorts where we call people in groups according to their age group, 20 to 30, 30 to 40, 40 to 50. and then we take them to class. Before COVID, obviously, would come into a class, would come to Workers' House, and then we have regional classes at designated places in our regional offices. But now, because of the COVID era, we're holding these classes online. So once somebody signs up, we'll be sharing a link with them. Apple will direct us on where to, on whoever is interested, and we'll share feedback with you. And then you will be able to move with a class according to your age group once a month for 6 whole sessions, and hopefully, prayerfully, and hopefully make sound financial decisions at the end of that journey. We'll be able to graduate you. Apple will share the links.
Apple, would you like to add anything on that?
Apollo, anything about the classes? You're going to share the links?
I don't know if you get me, Becky and Sebastian.
We can hear you now. We can hear you
Yes.
now.
We'll be sharing.
Yeah, we can hear you now.
I'll be sharing a link with Sebastian, and it will also be on the videos that we shall be sending through after
The success
from
stories.
today onwards. But also, anyone can feel free to walk to us and propose.
I think Apollo has a network connection problem.
Is back on? Okay, maybe
I think what he meant to say, if anyone can get in touch with us and propose a program that's tailored for their organization. I think that's what he meant to say. Yeah. I can see another question here.
Let me just read a few and I pose them to you. Some of the interesting comments here from Alex is saying, we the working class are surely the most illiterate financially. Becky's presentation shows clearly how we are busy eating our check every month. What an eye-opener. I think you've already gotten someone here who is ready to join the campaign of turning around the other figure of 95 to at least 60. Thank you, Alex. And going back into the chat, the questions is saying, how can we join your classes? I think that one has been answered. He's saying, Becky, can you please share what are the most appropriate ventures that one can invest for productive returns?
I talked about
one
that.
hand's money. Okay. The average period of 6 years of savings is very worrying indeed. We are on an average. Extremely
worrying.
Yeah, sure. In the formal employment for more than that, it's should be at least about 20 years. That is the suggestion. Why this low period? That is again, Alex. So he's posing a question to you, depending on the researches you've carried out, depending on the interactions you've had with the customers. Why do you think this period is low? Because you're saying the average period is 6 years. Then again, the average money that anyone would part away with, if you had to share the money now, I think you can call it the membership per capita. I don't know how you can put it. Would be 1 million.
1 million. Let me just. The average, it's a combination of factors, but the reason why we put that number out there is because we want to challenge people to save a lot more. So what happens when somebody's in, there are many factors, and I'm going to mention some of them. When somebody is in formal employment, you saw the number, the dormant figures, out of the 1.3 million savers, 52% are dormant and 48% are active. So you'll find that when somebody leaves the formal workplace, sometimes even when they go into the informal sector and they're self-employed, because we don't have a savings culture, they don't even come back to opt to continue saving. They don't, because we have a voluntary savings scheme. But when people become dormant, we don't see the trends coming back to save because they appreciate saving, which is not a good thing, and which we would like through these money conversations to change. The other thing is that when you look at the different claim types, and this one I'm challenging you guys who are still working, when you look at the different claim types, we have 2 claim types that are age-related, that is age benefit and withdrawal benefit at retirement. But then we have 4 other claim types. Okay, let me take out the one of survivors where somebody has died. But the 3 other claim types, which somebody can get during their active work life cycle. And these are immigration grant, in case somebody moves and gets citizenship in another country, they're free to come and get their money. The other one is How can I forget? The other one, if somebody moves to a pensionable scheme, for example, today, if you move to Ministry of Finance and they're paying for you and you're sure you're in the pension scheme, you can come and get your money. But the challenge is that people are still in their active work employment. And the same goes when they get this money, they still lose it. So the question you need to ask yourself, if you are among those people who left this country and probably went to the US and got citizenship, why can't you develop another saving scheme in the US and leave this saving scheme in Uganda to run? Because you're still working, you're still active, you still have the energy, and you're still spending exchanging your energy, passion, skill, qualifications for a salary. What we see happening is that even when somebody is still in active employment and they're in their active work years and they get another job, sometimes people even come to get another job in a government scheme that is low, that is way below their skill set, just because they're targeting to get their NSSF money. And the cycle is the same. The cycle repeats itself. What they look at on their account excites them. Why? Because they haven't cultivated a savings culture in their own personal lives, so they can look at this money differently. If we cultivate a saving culture in our own personal lives, NSSF will just be another of your many buckets or your many accounts that speaks to your financial wellness. Why? Because you have built another asset base in your personal life that comes from the other money that comes to your account that doesn't go to NSSF. So what we see is that people are actually scheming to get into low-paying government jobs just to get their NSSF money because they are desperate, because they haven't saved over time, because they're not looking at money in a broad perspective, because they're not looking at money in terms of legacy. So that shortens, all those factors shorten the savings cycle with the fund. But if somebody knew that at 20 years old, I'm going to get a job whether I'm in informal, I'll get a job and then I'll save until 50. Even if they join the informal sector and they become self-employed, they'll simply come back to join the voluntary scheme and continue saving because they have appreciated saving and because their goals are perhaps what? Different. So those are some of the factors affecting the tenure for saving.
Thank you so much, Becky. To pose another question, this is actually also a comment from Kamali Shakur. He said, "Thanks for this session, Madam Becky. You've literally opened my eyes more. However, my question is, how can you know how much to put aside once you've paid rent? Let's assume your earning is around 800,000 shillings and 1 million, and your rent is like 350 or 400K. Trying to ask, how can you make...
Kamali Shakur, thank you so much for your question. I'm going to challenge you by giving you a, can I call it a puzzle, a riddle, or a question in return? I need you to think about the kind of life you would like to live at 50 or at 55. I usually tell my clients that when they come to get their money at 30 and they're desperate and they're still active enough to work, I always tell them, do you think you'll have the same energy at 50 or at 55? At that age, you don't even want to work, okay? Because the energy you have at 20, at 30 is not the same at 55, at 60, even at 70. So the way that I would look at that, and again, I encourage you to come to class so that you can think about this broadly, but the way that I would look at your question is to work backwards and have a vision and have a goal. Ask yourself this question. I wish I had my Excels with me, but I don't have them. If I'm comfortable living off 800,000 shillings on a monthly basis, please write this down, Kamali. If I'm comfortable living off 800,000 shillings on a monthly basis, that means what money will I be comfortable living at on a monthly basis when I'm 50, when I'm 60? If you tell yourself that I need 800,000 shillings on a monthly basis when I'm 50 to be comfortable and to be happy, just walk backwards and ask yourself, how big should your asset base be? Because right now, it's your employer's size of the asset base that's affording you 800,000 shillings on a monthly basis. The employer has an asset base, they've done their mathematics, they have their operational costs, and in there they have inserted that I can pay Shakur 800,000 shillings on a monthly basis, which makes you comfortable. Okay, so what then should Shakur do at 55 years old, at 60 years old, to live off 800,000 shillings on a monthly basis comfortably without the luxury of the asset base of their current employer? Even as I think about that question, even as I think about that question, Shakur, my mind is automatically working backwards. Because you see, having the kind of being at the kind of place that you desire at retirement, the work starts now. It doesn't start at retirement, and that is why we are crying out for more success stories. Once you work out that number, Shakur, you would be surprised that you'll even go into a house that has 100,000 shillings per month to pay rent. I have a joke with my team that I share, and I'll share it freely on this forum. A sister of mine keeps saying that if I discover that 400,000 shillings is actually eating my savings away, or is eating 400,000 shillings for rent, according to, if I'm spending 50% of my salary on rent and it's eating away at my hope for a luxurious life at 55 and at 60, she says, quarter level, work backwards, cut your coat according to your cloth. When you work out that number that you want, you will be an aggressive saver. You'll be an aggressive saver. You'll be an aggressive financial literacy student. You'll be an aggressive investor, because they're building blocks. They're building blocks to the place that you want. It's the same way when you look at, let me make it even easier for you. When you look at your NSSF balance, for instance, if your NSSF balance, I said it's only 5%. If your NSSF balance, say, is, what number can I use? Let me say 50 million. We saw a certain bracket that have above 1 million to 50 million. If your NSSF balance is 50 million, and then NSSF gives you a return today of 11%, get that return and divide it by 12 months. That 50 million, get that return that is given you. Just go to the money that you got this financial year and divide it by 12 months. That means that if you decided to enjoy the interest of your NSSF principal, let me call it a principal, this year, you just divide the money you got out in interest by 12 months, and that will be the money you'll be getting monthly. So again, challenge your psyche to say that money is perhaps not enough for you. It's probably not even, of course, it's not 800,000 shillings. So if your employer's asset base has been able to afford you 800,000 shillings per month, what asset base do you need to build for yourself at retirement to make sure that on a monthly basis you have the comfortable life that you want? Shakur, you'll automatically work backwards and ask, and the question of what rent you should pay will no longer be a question. You will just fit it into your goals. Your biggest issue should be, how much money should I save? How much money should I save? What investment class should I put this money? How many years should I give myself saving this money to get this kind of asset that I want? Many times people come to us and say, but you know what, I don't have enough money. I'm getting say 1.5 million a month. There's no reason I can even buy land. What land is there that can afford this kind of money? And that is why I said we need to look at money in terms of time. We need to give money a timeline. If a person who's getting 1.5 shillings a month had a goal to buy a piece of land, say for 6 million Uganda shillings, if they put away that 500 shillings on a monthly basis, wouldn't they have 6 million shillings at the end of 1 year? Or if they wanted to get land worth 12 million, if they put away 500,000 shillings for 2 years, wouldn't they have 12 million shillings at the end of 2 years? So it's, again, I go back to, you know how that guy on TV says, Shakur, I'm not addressing this to you. I'm just speaking to all of us. You know how somebody says, Toli muavu motwegu gomavu. A lot of the decisions we make about money have to do with our psyche. Like, how do we understand it? How do we look at it across a timeline? How do we look at it in terms of our goals? What is your goal? Are you able to define your goal? And you say, for me at retirement, I need X amount of money. If I have it, the monthlies will be like this. Once you have that goal in your mind, you will automatically work backwards, and all these things about how much rent should you pay, how much should you save, how much should you put away, what percentage, it speaks to your goals. And those goals come from the money conversations we're having like right now. You know that, for example, if I said I have a lady that I know, and I thought I don't know how much time we have, but let this be the last story, because it also answers the next question that I've seen about, I earn 500,000 shillings, what percentage of my salary can I save? I have a lady that I know, and again, I like these stories because they're extreme and anybody can fall the other side of the continuum. I have a lady that I know that earns 250,000 shillings on a monthly basis. She has a 50 by 100 plot of land somewhere in Namuongo, and she gives away 50 to a circle. Her and her friends have a circle where they pay each other 50,000. So when her round comes, she gets 250,000 shillings. So this lady, the reason she does that circle is because she wants to build rentals. So she came and told me, Madam, Auntie, wenaba n'emizigo gyange 1 nga buli muzigo gumpa emitwalo 10. Right now, I'm getting 250,000. Mizigo ginampa emitwalo 10. I can comfortably live off 500,000 shillings on a monthly basis. Once I achieve that goal, I will stop working. I'll stop being a maid in this person's house because I'll have achieved my goal. Because if my 250 can help me pay school fees for my son and give me something to eat and help me save, I was like, how will you be able to build those rentals at just that amount of money? She said, no, don't worry. Ngenda kuba bloka mploti yange, mfuna omuntu, etc. So you see, her goal is what allows her to work backwards and decide how much money do I need to save? How much money do I need to save away, to put away? How much money should I eat? How much money should I pay for rent now? How much money because of the goal that you have at retirement? Because you all know the investment vehicle at the end of the day is supposed to give you returns or an interest or a dividend, or I like to call them eggs. If you have a chicken, it gives you eggs. So how many eggs will you need on a monthly basis to survive? So you work backwards and ask yourself, how many hens do I need to have in my compound? If 5 hens can give me 5 eggs without killing my hens, so I need to make sure that I work towards getting the 3rd hen and the 5th hen and the etc. So look at your goal and work backwards and cut your coat according to your cloth, because you have a goal in mind and there's a place that you want to go to that will give you financial wellness. I think our time is up, Benedict, but I also hope that I have responded to Jonathan, Segane, and Shakur. Thank you.
Thank you so much, Becky. I must say this has been so insightful. So many questions still coming in, but I would suggest that due to the purposes of keeping time, we'll really keep it at that. You give us some of the parting shots, and we'll take note of all the questions. The good thing, we have all the registrations and the emails. We'll have these questions answered. And of course, in case of anything, Becky, you also give us some of the handles, website, information channels that someone can reach to get some of the questions answered. And as we conclude this. So as we conclude, Becky, kindly give us some of the parting shots regarding the whole figures we looked at, the general picture we painted, looking at this figure that we need to worry about, the 5% vis-a-vis the 95%. What are some of the parting shots would you give the listeners? Thank you.
Benedict, I can't say that I'll say anything different from what I've already said. First of all, I just want to thank you for allowing us to have yet another money conversation. We hope that our dream is that, because the burden is huge in our country, our dream is that we'll have so many players and so many partners in this field, just having money conversations left, right, and center. I go to class a lot for financial literacy, and that is why I'm able to share some insights in this area. But one of my teachers again challenged me once and told me that I know that some of us have gone into a place, and I don't want to talk about politics, but some of us have gone into a place where we have blocked our mind because of the political climate and environment in our nation. And people will say that government to Yambe, everything government to Yambe, government to Yambe. So a friend of mine asked me, one of our teachers asked me, Becky, if you decide to get your goat in your backyard and will your goat refuse to give birth because the roads are not done? And the answer is that, of course, no. So the opportunities are limitless if we empower ourselves with information. There's so many opportunities out there. There's so many opportunities. There's so much that we say in our classes. We talk about time. How do you spend your time? If you spend 8 hours at work, are you sure you cannot have balance hours for you to create another income stream? What income streams do you have? Are there income streams where I have to be present? Are there income streams where I don't have to be present? Are there people who have more than 7 income streams in their lives because they have a particular goal? So again, the information is a lot. My parting thoughts are, one, we need to change the narrative together. Government together to Yamba. Okay, perhaps they get to Yamba, but the ball is in our courts to change the narrative for your family. And I don't want, when Benedict said the worrying figures, I don't want these figures to worry you. I want these figures to challenge you, because I believe in the snowball effect or the ripple effect. If I have this conversation in my household with my siblings, with my sisters and my brothers and my friends, and you have this conversation, guess what? 50 people listening in right now having this conversation with 5 other people Guess how many people that will be? Or on an average, every Ugandan household has 5 to 7 members. So if 50 people listening in, for me, those are 5 times 5, 5 times 7 people that will be impacted, but not just now, even for the generations to come. So I don't want these figures to worry you. I want these figures to challenge you, but there's so much information out there on Money Talk, and the fund is giving out this information for free. So please get yourself a slot and learn as much as you can, and make sure that your story at retirement is different. Your story at retirement is different from those figures, but also more importantly, I really, really care about our children and the generations that are going to come after us. The ball is in our court to set the stage for the guys that are coming after us, and they need to refer back to us and say, "Nalinayo Jaja Becky, Nalinayo Jaja Gority, Nalinayo Jaja Apollo, Nalinayo Jaja Benedict, Nalinayo Jaja Samuel, Jaja Kamali, Jaja Richard, Jaja Segane, Jaja Andrew." We need to change the narrative together. If it starts as an individual, in your household, with your family, who knows, we could have an avalanche 20 years from now just from having money conversations in different forums in this nation. Thank you so much, Benedict. And again, I hope that we learned from each other. Apollo will be sharing the handles and the different links from the fund for you to get in touch and learn more about what we have to offer in terms of financial literacy. Thank you.
Thank you,
Becky. Just to interrupt you a bit, I've shared the links. I've shared the links on the chat group.
Oh, sure. I've seen it. Just to the members, kindly check out the link in the Q&A portal in the session, and you can actually, in the comments section, you could pick that link and then follow to get more details regarding the questions we've been asking. Thank you so much. From now, from the Institute, I and myself and the facilitators we had today, thank you so much, Becky. We look forward to have more engagements, and the feedback that's coming out. People are so interested in those classes to really improve on their financial literacy. Probably we shall look forward on how to do a mobilization on both ends, if it can come up as a partnership, and we see how best we can turn around this figure, because you understand that the banking sector holds I have to be corrected, the biggest percentage of your members and SSF. So we can have this and we partner to change this 5% to at least even 70 as possible. All right, thank you so much. And
thank you to
the rest of the members, we are still continuing. This has been a session for NSSF, and we're also continuing into another digital financial literacy. Now we've been on the traditional financial literacy. Now we are going into the digital financial webinar, which will also be coming in as Becky and Apollo sign out. Kindly stay online. You can tune in and listen more. Or if you are interested, Becky and Apollo, you could stay with us. For the information, we have Madam Diana coming in from DFA, as well as Mr. Kakulu, who is also a certified digital finance practitioner.
Your money can enable you to live a better life only when you budget and save before you spend. Act now. Learn how to manage your income and expenditure correctly at the Banking Financial Services Awareness Month. Meet the financial experts. Learn how to deal with financial hardships like those caused by COVID-19. Be money smart. Be part of the Banking and Financial Services Awareness Month. Visit www.yourmoneycan.or.ug. Brought to you by the Uganda Institute of Banking and Financial Services, UIBFS.